Shyam Srinivasan, Aisha, let's go across to him and understand the numbers a bit better. MD and CEO of Federal Bank. Thanks very much for joining us, Mr. Srinivasan. How would you look at the quarter gone by? There's been a strong other income growth which has helped earnings. But how sustainable does the environment look in maintaining this asset quality as well as the credit growth cycle in the wake of rising rates?
Thank you, Tanvi. Yes, like we've pointed out now for many quarters, sequentially the operating profit and the business momentum continues to be very strong. We believe that bank like us well positioned to get credit market share growth. We are now well north of 1% in terms of credit growth. If you remember, 4 to 6 quarters back we were close to 0.80. So we are picking share. Our growth continues to outpace market by almost 3x, and this is fairly well spread between corporate, retail, SME, agri. And in this quarter, what is most heartening is the mix between our businesses, wholesale, retail, is almost beginning to look 50-50, which is encouraging. Retail grew almost 30% Y on Y, and within retail, while home loan continues to do exceedingly well, some of our new initiatives like retail personal loans, unsecured loans are all beginning to gain traction. So our belief, operating momentum is strong, will continue to be strong. Credit quality, because of choices made a few years ago, we didn't go out big into the infra and some of the other stress sectors, and over the years we've addressed most of it. So I believe that at this juncture we are quite on guidance in terms of both credit quality as also the growth, and I'm hopeful that what we've delivered this quarter should be a good base to work off.
To see, Mr. Srinivasan, that you've got a very limited impact of the Kerala floods, because going into your earnings, the market was a little worried about as to how the quarterly hit because of the unfortunate floods in Kerala is going to impact you. But just going by your numbers, it doesn't seem like it's had much of a hit.
No, Aisha, when immediately after the floods, I did talk to all of you and pointed out that there has to be two parts to it. One is the human and social impact, and second is the business impact. We had made certain sort of view on what our implications of the flood will be, and that's pretty much played out. We had said roughly 50 odd crores of slippages may increase for between Q2, Q3 and Q4. I think that will happen, but we have taken it in our stride. There are other areas that are compensating for it, and people are also quite resilient and coming back. So I would not over amplify the financial problems. There is still a sort of resurrection of lives and livelihood that is going on, but I'm quite confident that the what we've seen in Q2 will be repeated or better in Q3 and Q4.
Right. But do you think that, with the overall credit numbers picking up, that, the risk is coming back into the market where corporates, are looking to raise money, or seek loans? Do you think that the credit culture is improving?
Absolutely, yes. The differentiation between very good borrowers and people who have been on the periphery is now very stark and visible, particularly because some participants who had dominated sections of the growth in the last 2 years are currently facing their own set of challenges. So there is a demand, and there are a few of us who are capable of fulfilling that demand. The best certainly demand best pricing, but I think the play has opened up for good and sensible lending, and we believe we can participate in that very meaningfully. The credit growth opportunity, which I had said even before the end of this quarter, we think there are some green shoots in certain areas, and we are quite confident that our capability to grow in that remains. If you see our investor deck, we have pointed out saying we have redirected some of our focus on manufacturing entities. We started gaining share, and I think the opportunity increasingly will be in those kind of both greenfield and brownfield, and we want to participate in that.
So, Mr. Srinivasan, if I had to ask you as to what the the breakup of your slippages is in the second quarter, which stands at a total of about 477 crore rupees, what's the corporate book slippage that you've seen in the quarter gone by?
Corporate for the total 477, about 120 crores was corporate, 350 crores was the rest, retail, SME and agri, out of which about 210 were in Kerala. Normally it's about 160 and the rest is about 130, 140 rest of India. So overall slippages is about 477.
Okay. Right. I want to understand, given what you've done on the asset quality front, which has been a fairly stable picture despite the challenges that you may have faced with the impact of the floods also expected to come through. What has largely been your strategy with regards to provisions?
Our provision for this quarter was 150 crores. We had an exceedingly good credit growth sequentially, almost 7,000 crores. So the standard asset provisions is about 32 crores. So 150 plus 32 is about 180 odd crores. Then there was an investment provision of about 105. Investment provision is again broken into three parts. One is the yield related provisioning of about 30 crores. Two, we made two strategic investments this quarter. One is an investment into Equirus, which is our investment banking associate. So there is a provision of about, there is an investment of about 20 odd crores in that, and also a provision in CCIL, investment in CCIL, for which we made a provision. These are both one-time investment related provisions based on regulations. And the last is we strengthened our security receipt book by providing another 40 crores. So effectively the 105 crores of provision in investment provisions, out of which market related is 30 odd, equity related is 30 odd, security receipt strengthening is about 40 odd crores. That's how the split is. And our provision coverage continues to be conservative. On the margin we are providing 40% for everything that slips.
So if I look at your stressed book, that's shown an uptick of roughly about 4% on a sequential basis, and the slippages have as well on a sequential basis have come in higher. What's the outlook that you can provide to the market? Do you sense that these two numbers will actually ease down in the next few quarters, or is there a chance of them showing a remarkable uptick going forward?
I think the question is not very clear, but let me try and give you my sense on the stressed book itself.
Sure.
If you take the net NPA plus security receipts held plus the standard restructured, that book is now about 2,000 crores, roughly 2.01% of our total assets. The same thing 8 quarters back was 4,000 plus crores. So we have meaningfully virtually halved the stressed asset of the book, and that momentum will continue because we are seeing lower and increase in slippages trending lower. Second, we had guided at the beginning of the year that the credit cost will be roughly 65 to 70 basis points. Despite all that has happened in Kerala, we are still holding on to that because our belief is that we have a good grip on our outcomes for the coming quarters. So both in terms of slippages and in terms of credit costs, our guidance remains the same that it was at the beginning of financial year 19.
What I wanted to know on whether or not both these parameters will ease going forward or not.
If I were to ask...
it will, because some parts of it is already consumed, so the remaining...
No, I think we pretty much got clarity on that front. Just one final word. In terms of the guidance that you can offer, Mr. Srinivasan, to investors, if you're seeing green shoots of recovery, what should they expect from Federal Bank's earnings from an FY19 perspective?
Tanvi, I can't tell you something differently from what we've been guiding. We said at the beginning of financial 19 that it will be a strong growth year. Operating metrics will look very strong, and we think the 2 quarters that have gone by does reflect what I have said. We had also said the credit cost for the year will be 65 to 70 basis points, and we think we are well on track for that despite the Kerala related impact. So I think our commitment on the metrics that we had promised at the beginning of the year are shaping out. We are turning out to be a net attractive employer. We are seeing a lot of interest by good high potential seniors coming in. We've brought in a lot of them. So the verticals that we have created, the business momentum that is there, the portfolio quality, all of that which we had promised is on track. So I'm hoping that the investors like what we are doing.
Yes, indeed, which is why your stock is up 6%. We wish you the very best in your endeavors for the future. Mr. Srinivasan, thanks very much for joining us.
Thank you.